No worries and easy. That's right. Okay, hey guys, this is being recorded. One thing I say at the beginning of all of these webinars is watch it again, especially if you're newer to options. And even if you are a veteran trader, I think that I'll have some takeaways here for you that you guys will be able to at least learn something from it, even if you've been trading for years, like I said. Anyway, let me go over a couple of things. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading in college with some money I'd earned, and then after graduating college, moved up to Chicago and started working on the board working at the board of trade as a runner. Sold all my stocks and everything else, and bought myself a badge. I've been trading ever since college, so that's over 20 some odd years. Got to go over this disclaimer really quick. Any opinions, news, research, and analysis or other information should be considered general commentary, not investment advice, you guys. I'm actually even probably going to be talking about stocks or underlyings that I may very well have in my own account. I'm not trying to get you guys ever to lemming off the cliff with me. Don't ever believe that I'm trying to give you a trade recommendation because I don't know your risk parameters. I don't know what's in your portfolios. So it is not very responsible for me to do something like that. The other thing is, I'm talking about these because I believe in my market direction assumption. So if, for instance, with this particular strategy, I may have something on where I think that it's a bullish move, and therefore that's why all of these things worked out for that particular strategy on that underlying. So I'm not trying to get you guys to run off the cliff with me. I'm just trying to teach you guys so you can implement it in your portfolios in your own way. Please remember the past performance of any trading system or methodology is not necessarily indicative of future results. Are all these webinars posted on the site? Yeah, Noel, you can reach out to us at trading@protraderstrategies.com. And you can follow me on Twitter at Wolfman's blog. I throw out a lot of my earnings trades on there because I do my market commentaries in the morning. I want to make sure that you guys that are participating in those daily market commentaries get that information as well. And you can also follow our parent company at ProTraderStrat for different market wisdoms and daily deals for that matter. All right, so this is going to be on the naked short put. We did the naked short call. This is the naked short put. So this is going to be for a bullish assumption. But having said that, the market could trade sideways and even slightly down in this particular strategy, and we still make money. But the idea here is when we're playing a short put, that is for a bullish move. We do not really want a bearish move because it's going to make us struggle a little bit. We'd rather have that move happen right away and we're off to the races. We're also going to be taking advantage of theta decay. Anytime you're selling an option, you want that theta decay because if you sold something for $50 and you can buy it back for $25 because of that theta decay, that's what we're looking for. Volatility crush will help expedite our exit on this particular underlying. If we get the theta decay, which is going to happen on a daily basis, but all of a sudden volatility comes out, and you will see volatility come out quite rapidly in a bullish move. Okay, so we want to see a bullish move happen. We want that volatility to crush and the ability to get us out of this rather quickly. All right, so this goes along with all of my rules, right? We go through these step by step to make sure that the underlying we're trading has the appropriate appropriate environment, a good market, and several other things. But always go through these steps as you're going along, picking the right environment. For option collection, 90% of the time, we are going to be looking to collect a credit anytime we have high implied volatility. So it's really a implied volatility percent. Sorry, I didn't have this set up to go over to the right side here. Let me make sure I have this set up right. All right, sorry, squeeze that down. So picking the right environment. We need implied volatility percent right here, current implied volatility percent above 50 for selling premium strategies. If it's an ETF, like say for instance SPY, then anything above 30, sorry, SPY, anything above 30 is what we're looking for an ETF. So this is 15, that wouldn't necessarily, that's not going to meet our parameters for this particular underlying. So we want implied volatility percent above 50 for a stock and above 30 for an ETF, because an ETF, you guys, has a bunch of different stocks in there. All of their volatilities are going to average one another out, and it has a tendency to not spike like we would see with regular underlyings for that matter. So we want implied volatility percent above 50. And I'll show you when we pull up the screen a little bit later how to figure that out yourself. If your platform doesn't do it, sometimes there's breaks in the chart and it doesn't allow the algorithm to calculate it. So I'll show you how to do that a little bit later once we get rolling here. And we're picking the right underlying. Now, what does that mean, picking the right underlying? Well, we need a stock that has a lot of volume and open interest. So what we want to do is a stock that's over $100, we move the decimal place 3 ticks to the left, and that's how wide the bid ask should be in our option montage. So, and we're going to be looking at the monthlies more so than the weeklies on this for this rule to make sure it fits. But you can look at the monthlies. 28 cents or 23 cents, move it 3 ticks to the left, 23 cents to the bid to the ask, and Adobe isn't making that cut right now. During the day, it may very well, but that's our rule of thumb. Something like Disney, anything under $100, we're just going to say 10 cents wide. Disney will fit that almost every single time. It's a stock that's $100 inside of 10 cents. So stocks that are under $100, we want to have less than 10 cents to the bid ask right here. As you can see, Walmart's under $100 stock. Bid ask is tight. I'm not saying we're looking at the IV percent, albeit it does have implied volatility percent above 50. It looks like it has earnings. So I don't want to trade this well in advance of earnings, you guys. This strategy is for clean months. When we're going in and setting this up, we have a bullish assumption in something. We want to have a clean month where we aren't going to have an earnings land in that particular underlying during our option lifetime. All right. So for that, Walmart has its earnings even inside this month. You know, if the month was over here and we wanted to get in here, that's fine. We just don't want to be in the month with that earnings. The reason why, usually when we head into earnings, you see volatility start to spike a little bit. You can see back when it wasn't as volatile as it is now, but you can see how it was rallying up into the earnings and then it breaks down. That's the volatility crush we're seeing. All right. So generally speaking, around earnings, we're going to see implied volatility start to expand. So if we get in well before that move, when volatility expands, those premiums are going to go up, guys. It doesn't matter if the market is moving north and volatility is expanding into that. You're going to see your premiums inflate as well. So we don't want that. We want the premiums to deflate or see the volatility come out. So we want the clean month. We don't want to get involved in that earnings well in advance of it, because you're going to definitely see most times you're going to see volatility expand on you, and you don't want to take that additional risk, right? You're doing a directional risk on an earnings, and you could be well inside the market maker move if you do it too far in advance. All right, and then got too many things going here. All right, so that's picking the right underlying. Everybody clear a concept on that? When you're looking at the option montage, the monthlies, inside of 45 days, you go further way out, you're going out 90 days, that rule doesn't necessarily apply. Look at the ones that are inside of 45 days, the monthlies, and look at those bid asks to make sure they're within that rule. If they are, usually further out, there's going to be participation in there. They're going to have a little bit tighter markets. But if it starts out in these close to expiration monthlies, that the bid ask is really wide, you guys, way out, they're going to be even worse. And you're going to have to give up too much edge to get in and get out. So make sure you're playing around with tight markets. Apple, yeah, Apple just reported, and I think I saw that they were above 50 still. Or actually, you know what? They might have dropped down to 30. You know, if they just had earnings and you believe that there's going to be a continued volatility crush going on, I've done it after earnings, but just keep in mind you've missed most of that volatility crush. All right, picking the right duration. I kind of mentioned this already. This is theta decay, and of course it is at the money. We're not going to be doing at the money ones, but all options decay relatively close to this. All right, you know, we can argue back and forth at different option deltas are going to decay differently. All this is, you guys, is to give you a mental picture of what's going on with that theta decay. And when we're way out here, 100 days out, theta isn't coming out very quickly. And the further out this goes, this is going to, you know, I'll ramp this up a little bit, but the further out this goes, it's going to kind of flatten out even more. All right. The closer we get, you can see that this theta decay, we're inside. I talked about being inside of 45 days, you know, 35 days. This is usually when I kind of start putting these strategies on. All right. And we're right in that wheelhouse. You know, I will go up to inside of, you know, I might even go as far as this as well. I would definitely like to be out by this area, 7 days to expiration. There's a lot of theta decay that goes on. The other 50% drop for the most part, but there's a lot of other things going on here. There's some gamma risk and stuff like that that I'm not going to really want to talk about right now. So this is the wheelhouse because of this theta decay. And remember, I was talking about volatility. What volatility does to this line is it kind of pushes it out like this. It in a sense holds off theta as those premiums get pumped up, you know, is another way to look at it. And then when volatility comes out, it rushes down to catch up. And that's what we would love to see happen, is that volatility come out and we get all of that theta decay. You're confused about timing on volatility crush. When? Day after earnings to put on the trade. Chuck, no, I'm just saying if you waited until after the day after earnings, or, you know, right after the earnings happen, you're still going to see for a couple of days a little bit of volatility coming out. All right. Because the news is out. Volatility is created by the unknown or fear. All right. Once that earning comes out, there's not a whole lot of unknown anymore, right? The market's made a move. It's probably going to continue on that path and several other things. So the volatility really comes out. But some people like to play it right after to get that extra little bit of move. I usually stay away from it. I would rather have a clean month and play it that way. But I am not opposed to you trying to take advantage of further volatility coming out, is all I'm saying. But with this one, I'm going to try and pick a stock that has no earnings here, okay, all the way to expiration. I don't want any earnings laying in here. You know, if the earnings happens right here in the next next options expiration cycle, then I don't care, because that volatility is not going to affect this option over here. Does that make sense? But is it possible to find 50% ID in clean months? Absolutely, no. And I've actually gone through and vetted. I've got 1, 2, 3, 4, 5, 6, 7, 8, 9 that I vetted, and one I couldn't help myself. I had to pull the trigger, you guys. Usually when I do these webinars, I wait till Monday after I've talked about all these different stocks that I vetted to implement this strategy. When you see the chart, you're going to understand why I had to pull the trigger on it today. I couldn't wait. I couldn't help myself, you guys. I'm sorry. But I'm not trying to get you guys to jump off the cliff with me, because my market assumption in this particular underlying may be very different than yours. So I'll just give you examples of why I picked that one. And picking the right strikes. What we're going to be looking at is, you know, this is the bell curve, okay? And believe it or not, the bell curve is representative of delta. So it's probabilities. You know, the bell curve is all about probabilities. So are options. And what we're going to be looking at is this one standard deviation put option. Okay? Why the one standard deviation? Well, it's basically where you get your best bang for your buck is the easiest way to say it. But if you add up the 13.6, the 2.1, the 0.1, and all these other little ones that go in there, you basically come out to around 16. So we're going to be looking at the 16 put delta. That gives us a 85% or 84% probability of success, right? You know, if you go out and flip a coin, it's 50-50. And that's like picking a stock. If you went out and bought a stock, your probabilities of success at that time of implementation is 50-50. With the way I'm trading this underlying, you're basically taking a die, a six-headed or six-sided dice, a die, and you get to pick one number. And you pick the 3. So as long as the 3 doesn't come up, you win in this strategy. So those are pretty good odds, right? 1 out of 6. That's pretty close to what we're looking at here. 16% probability. The other one's a little bit higher, but you get the gist. So a high probability of success. 84% of the time, the stock is going to land in this area. We're looking for it to not land in our 16% probability. So pretty good probability of success, all right? But we're looking for 84% of the time, it's going to land over here. And that is really good odds of a trade. Yes, Eileen, you can leave. We are recording this, and even if you watched all of it, I suggest that everybody who is newer to this strategy or my webinars to please watch it again, so some of the nuances really stick in there. If the market crashes, ID goes up. So you have to be willing to hold the stock. Yes, and you know, if you have stocks in your portfolio, this is a great way to add more stocks. You hear like financial advisors and everybody else, dollar cost averaging, you know, buy every so many months. And if it's down, you buy it then or whatever. My theory is sell those puts where you want to buy it all day long and collect that premium. When finally the stock comes down there, then you get the stock at your price. And I would suggest doing that, especially if you like to add stock. Say, for instance, you have XOM and you're thinking, well, they've taken a big dramatic move down. Well, stock's at 70. How can all these oil stocks be losing money? Well, they aren't really, but at the end of the day, higher margins with a $70 gasoline, these fracking guys are going to be doing very well. So that could be part of your market assumption as well. That stock's beat up, it's due for a move higher, and that's how you want to take advantage of it. But if it does come down, you are at risk for sure. But think about it. I mean, it's only going to happen 16% of the time. And if it does happen, the first time you guys do this strategy, if that does happen, just look at it like, hey, they bit me on the first one. Of course they did. Probabilities beat me. Now the next 8.5 times I do it, it's going to be a winner. So, you know, those next 8.5 times are going to make up for that loss. All right. And knowing your exit strategy. With me, anytime I'm selling premium, you guys, I'm looking to take about 50% of my max profit. So if I collected 50 cents on this strategy, I'm looking to get out at around 25 cents. I don't like to take it all the way in and squeeze it out for the last penny, you guys. No, I take the winners and I run. You know, I do the same thing at casinos. If I'm up money, I basically take all my money that I'm up, put it in a separate pocket, and I continue to play with the amount of money that I came with, and I never touch that other pocket. But get out early, get out safely, all right? So know your exit strategy. 50% of max profit. Now, one thing to note, a lot of people are going to be like, well, what happens when it goes against me, right? There's a couple of things you can do. If we're selling this 16 delta put that we talked about, and I'm not using Walmart as a necessarily example. Here, I'll just use Caterpillar. All right, because Caterpillar I know has high implied volatility percent, still above 50. We can see on the charts, it's already had the earnings, so it's got clean months ahead, high implied volatility. You know, I think it's bullish. The economy is doing pretty well. You know, different ways you can look at it. This as a double bottom, you know, the 200-day moving average, this Fibonacci level, all of those different things. I look at all of those, to be quite honest. So in that, you would be wanting to sell puts somewhere down in here, right? Because you got a bunch of different support levels. Now, with that, the market comes down. We're going to be looking at the 16 delta, you know, or start out around the 16 delta, and then it's going to be a pick 'em. What do you want to do? Do you want the dollar or do you want the $1.65? I'd probably lean towards the dollar, and go slightly further away to increase my probabilities of success, right? That being said, if I were to sell this one, I would be getting out at like 45 cents or something like that, about 50% of my max profit, right? Now the market comes down here. The probabilities of CAT having my strike, which is the 130 strike, be in the money by 1 penny, which means the underlying is trading on June 15th at, you know, 12:59 in the, or sorry, at 4 o'clock, 3:59 East Coast time. If it's trading at 129.99, that's the probability, 12%. On that last day, 1 penny puts me 1 penny in the money. It's only a 12% probability. Probability of the market coming down and testing me is almost 25%. It's 2 times the delta, and that's a little floor trader hack. Nobody else is going to tell you unless they trade it on the floor. That's the only people that know that little trick, really. It's 2 times the delta is the probability during the next 42 days that Caterpillar will come down and trade 130. So twice the probability, all right? So knowing that will help you keep your wits together. Now, usually I'm going to pull the ripcord at certain levels that I see. So I'm looking at the 130 there. This is the 130. I'd be collecting $1, so my break even is 129. So, you know, I'd probably be looking at something like it getting down to somewhere in between here, maybe 127 or something like that is where I'd be getting out. I might even get out based on this Fibonacci level. I'd say, hey, you know, I'm short the 130 puts. If it breaks below this Fibonacci, this 50 Fibonacci, that means it's probably going to go to the 61 and maybe even the 78, just based on Fibonacci, you know, rules in a sense. But having said that, you know, pick your exit strategy on a loser that way. The other thing you can do also, if you are getting close, maybe we're like 10 days, 20 days out, and it starts testing me, and you're like, I don't know if we have enough room to rally or whatever, you can go and sell a call against it. I have no problem selling a call against that and creating a strangle. You're collecting more premium, increasing your break even to the downside. One thing I would not do is throw a long put in there to, you know, cover my risk. If I was going to do something like that, you guys, I'd just cover this trade for the loss. Don't throw good money at bad money, and that means like going out and buying a put to protect your short put. That doesn't work out very well. It's just dump out of it, because basically all you're doing is making it so you don't have more of a loss, and getting out does the same thing. So if you were still bullish, you could go out and sell a call to collect a little bit more premium to buy yourself a little bit more room to the downside. Does that make sense? And I see a bunch of questions coming by, so let me try and get to some of those. If the market volatility crush, I already saw that. So who calculates these probability numbers in the options chains? It is based on a lot of different things. You know, you have Black-Scholes and stuff like that. All of that stuff goes into it. Volatility gets jammed in there. So it's basically a big, huge, ugly, scary math problem. Where would you sell the call? Where would I sell the call? I would sell the call at a level, you know, I mean, depending on how far it went against me, you could go all the way down to the strangle, sell the 130, but I would try and collect about, you know, I'd probably be selling around a 36 delta at that time. So it would be pretty tight. And the reason why I pick a 36 delta is it's about a half a standard deviation move. And when you're in that tight, I'll take that 36% probability of my call being out of the money to help me out. So that's about where I would sell it, somewhere between that 36 delta. And if it had gone down and it was trading around 125 or 130, most likely I'm going to be out by that time, but you might have to go all the way down to selling a strangle. So you'd sell the 130 calls as well. Okay, depending on how aggressive you are, or if your market assumption's starting to get a little bit iffy, like, hey, I think it's going to stay here right on the 130. Well, then you could go out and sell the strangle, or sorry, the straddle, which is the same strikes. Okay, everybody clear concept on the exit strategy? 50% of our max profit is what we're looking for that. And ultimately, what that does is getting out early increases your probabilities of success even further. So, our probabilities of success, quote unquote, with the delta is a 84% probability. But when you're getting out early, you're also increasing those probabilities. And I don't have math on that, you guys. It's just it's pretty much a known fact. Can you explain the 2 times the delta again without touching? Or it's actually 2 times the delta is the probability of being tested within the option expiration. So delta tells us my probabilities of being 1 penny in the money is the delta. That's percent, 12%. So the floor trader hack is during the next 42 days, during that option expiration cycle that I'm looking at right now. If you say 2 times the delta, that's the probabilities of it coming down and Caterpillar testing or trading 130 in the next 42 days. Does that make sense? Why not sell the in the money put for a higher premium if you are bullish? Yeah, you could, but there's a lot. You're really increasing your risk profile by doing that, right? Because if you're selling the in the money put, your probabilities of success here are only 12, right? My probabilities of this strike being in the money is 88% in the next 42 days. I don't like those probabilities even for that big beefy premium, right? Why not let it expire, especially if you don't mind buying the stock? Gary, if you don't mind buying the stock, then absolutely you can do that. I don't like having a lot of stocks in my trading portfolio. I do have stocks that I trade options against, Gary. So I'm usually doing covered calls, and then when they get called away from me, I start selling puts, and that's because I want those. So that's how I trade my other long-term account is basically I have stocks in there that I've held, and I trade around them with covered calls and just selling puts. But this account is strictly for trading, and I don't like to carry that kind of inventory here. It just basically is eating up my margin. If you own a stock, that's a lot of margin. I show other ways also to trade stocks that are not margin hogs, but those are some of the ones I just kind of sit on for a long time. All right, so knowing your exit strategy. Max profit, anytime we do a max profit, it's the premium received, okay? Also, max loss is unlimited. Well, it's unlimited to 0, but it's going to feel unlimited, believe me. And never let that ride out unless you actually, like Gary said, you really want the stock. And finally, the break even is when the underlying price, the underlying is trading, where the put strike is minus the premium. So if I was doing the 100 puts and I collected 50 cents, it would be when the underlying is trading at $99.50. That would be my break even. Now, if it happens immediately, it's not going to feel like that's your break even. That break even is dependent on expiration day. Okay. So, but that's the only real way to write it up as your break even. Okay, so without further ado, this is usually at the part of the webinar where I throw it out to you guys. Give me some stocks you guys want to look at. We'll go run it through those different rules that I have, and see if it is appropriate for this particular strategy. And we'll just kind of walk through it step by step. All right, one question came up real quick. All right, see, you guys are blowing me up today. All right, should the short strike be outside the monthly ATR of the stock? You know, Roger, if you're trading off of that, then you could do that. I mean, everybody has their different way of picking their location, I guess, if you will. I usually just kind of I'll go through what I usually do here in just a second. So Tesla, somebody is bullish Tesla. You clearly haven't been watching my daily market commentaries. I'm just kidding. Anyway, so Tesla, if we're bullish Tesla, they did make a couple of nice moves here. They also they did miss on earnings. Elon Musk is loved by all, so it does look like it did make a solid little bounce. So if you wanted to do that, you know, you can throw up if you like to do Fibonacci. You know, you could just throw up. I'm going to just do it real clean, quick and dirty. So clearly this Fibonacci, this 23 Fibonacci level held pretty strong, right? So anything below that looks pretty good to me. Maybe the 160s where I'd be comfortable selling it, or the 260s. So let's see if we can just look at it. Oh yeah, I can get well below that. 16 delta is the 250s. So, you know, and if you wanted to go even further out than that, because it's such a juicy premium, you can go out to the 10 delta. I mean, I just like to start at the 16 delta and then kind of weigh my options from there. You know, if you went all the way down to the 200 delta or something like that, you're still catching a nice fat premium. What's the IV percent? It's a little bit low. As you can see, the volatility did get crushed right after the earnings. It may go a little bit further, but that's pretty simple. You know, picking those 230s or even those 240s. I might even pick the 240s for that matter. It makes other than your rule about 50% of profits, what would be your biggest point to get out of the trade if it goes against you when selling a naked put? Great question, Chuck. If, for one, you hear some news out there and it changes your market assumption, I'm not going to sit around and wait. Trigger points, yeah. So a trigger for me would be is if I saw news that changed my market assumption or had a gut feeling my market assumption was not correct anymore. You guys, one thing I say, one thing I didn't mention at the very beginning, I started out college with a psychology degree. And one thing I've gone through with my trading is that psychology probably served me better than my finance degree. All right. And one thing I have to say about that, always trust your gut, especially when trading, you guys, because there's so much information that we take in on a daily basis that we may not even think we heard. All of that stuff goes into our brain, you guys. And despite the fact that we don't really pull an exact thought, but we just have this feeling, that to me is kind of like, you ever like walk into a room, like you're in your house and you're like, oh, I got to go do that real quick. And you walk into that room and you're staring in there and you're like, I know I came in this room for a reason, but I can't think of what it is right now. It's that same thing. It's like that's the gut feeling. Like you walked into that room and you really have no idea why you walked in there because you forgot about it, but it's up there in your brain telling you, you need to be here. Figure it out. It's the same idea with trading. You get that gut feeling, you guys. Just pull the ripcord. I don't care. You have a gut feeling, get out, because your brain is processing something you aren't necessarily comprehending, and there's nothing wrong with that. Just know that if you've been trading stocks and stuff like that, that you've done enough research, you've heard, you've taken in enough information that, you know, this is a real meaningful thing that you need to jump on. What is the blue triangle on your chart? Can you explain that? No, that is market profile, and I actually do a whole webinar on how to trade that. So please check that out. I don't have enough time. Sorry to do that right now in this video. Baidu, do you guys do you have a service where you could subscribe to show you your trades, entries, and exit. Yeah, Charles, I do. It's actually my daily market commentaries. I do them every day. I start out, I go over the economic data that's released, what that means to the overall market. I go through several charts, probably 10 or 15 charts, maybe 10 charts. And then I also go over all the trades I added, all the trades I took off, and right now all of the earnings trades that I'm doing. So yes, I do that on a daily basis for everybody. And I do tweet out my earnings trades. I'll say, hey, I'm selling puts in this, or I'm selling calls, or doing a strangle, that kind of stuff. And those, on my Twitter, I'll put that out because early in the morning, I haven't done those earnings trades yet, but I want you guys to be able to take advantage of it. All right. A couple other ones I saw. What was it? CLX. All right, CLX looks like it found bottom. It's got a clean month, but look at that volatility crush. It's got to be below 50 on that. One thing to look at, it usually has, yeah, so move the decimal 3 ticks left, 12 cents. That's pretty close for 12 cents for government work in my eyes. And during the day, it does usually have tighter markets than that. 38, 36 is the ID percent, though, so I'd probably stay away from that. Bankrupt by the end of the year. Well, he's saying Clorox. Nobody's buying bleach anymore for the laundry. Sorry, Joy, picking up the kids. We were telling us about Tesla. Yeah, I just said that Tesla's volatility was a little bit too low, so I'm going to pass on Tesla for this one. Oh, bankrupt by the end of the year, Tesla. Well, you're not going to get any arguments from me. I actually have I own a 2-year put on Tesla that I'm long, and I already paid for it. If you watch the daily market commentaries, you saw me selling calls against it. I was increasing my risk a little bit, but I did sell calls against my long puts and paid for them. So I have free 2-year puts on in Tesla. All right, so another one I saw was AT&T. So let's look at AT&T. I'm probably not, you guys blew me up on this today, you guys. I'm not going to be able to, get to everybody's. But AT&T, let's look at it. It's above 50, albeit just barely. It's had a market move to the downside, clean month. And if you look at this chart right here, if we just kind of blow this up, that doji at the bottom of a move, that hangman is usually a very strong indication of a bottom, okay? Just as a, candlestick reading. Then you got confirmation to the upside. Doesn't mean we're out of the woods yet, but to me, that's a bit of a confirmation. I'd say, hey, looks like it's good enough to trade for sure. Everything else is going for it. Let's look and see if it's the right underlying. It's a $30 stock, so it should be 10 cents wide. It's 3 cents wide, so that fits the rule. All right, where would I want to sell them? Fibonacci is not necessarily going to help me here, but somewhere below 30. And on this, where would I get out? I'm going to go in there and I'm going to pick my underlying, or I'm going to pick my puts, and I don't have any levels below this for really support. Yeah, I could do Fibonacci extensions to the downside, but I will tell you, just like as a stock trader would, if the market breaks below 31.61, that means that this confirmation to the upside is broken, right? So I would get out of that trade at that level. I'm going to get out of my puts at that level as well. All right. So that would be my thing on AT&T. And one thing I forgot to mention, you guys, I have a stack of 3 ring folders here. We are working on something to get you guys so that you guys can constantly put these trades in something. But right now, what I do is I write down every single trade I do, why I came up with this market assumption, like being bullish, where I thought I was going to get out, if it's a loser, and where I would get out as a winner, and all of those things. I put all of that stuff down on a piece of paper on the day that I do the trade so that I stick to it. That's how you guys start to learn to be mechanical, you guys, is you have to separate the emotion. And it's hard to do because money is one of the biggest emotional drivers we have. And to separate making and losing money is very difficult for a lot of people. You have to do that with trading. You have to look at it like probabilities. When it breaks this support, I'm getting out, and you get out. You don't sit there. If you don't write it down, you're more likely to go, well, it broke 31.61. That's where I said I was going to get out, but really, no, I'm just going to wait. If it holds 31 and then it breaks 31, well, 30 has got to be a psychological level that everybody's going to defend. And you see, that is getting emotional. Get away from that. You write it down and you stick to it, all right? And I'm kind of getting angry a little bit on that, but that's a huge thing for me, is like is not following the rules. And when you don't follow the rules, it's because you're emotional. If you stay mechanical, you're following the rules, you're doing it. I said I was going to get out, I'm getting out. I don't care if it turns around. I don't even look back, you guys. When I get out of a trade, whether it's a winner or a loser, I never look back and see if I could have done better. Because you're only going to remember the times you look back and saw, oh, wait, hey, I could have done better on that. Next time I'm going to try and do it better. You're not going to look at all those times where it would have turned out bad and you would have lost a lot more money than you were willing to lose, in a sense. All right, so stick to that. How do we subscribe to your service? Charles, you can reach out to us at trading@protraderstrategies.com, but wait a few minutes. I've got something for you. All right, big dividend. You do want to worry about big dividends. That's a great point, Anthony. I think it was Anthony or Homero. Dividends. If you had like a $1.50 dividend in here, when there's a dividend on that ex-dividend date, the stock is supposed to drop by that amount. It doesn't always happen, but if it's like a 30-cent dividend, I wouldn't worry about it. It's probably not going to hurt it that much. Sometimes even on that ex-dividend date, the market spikes. So it is supposed to drop by that dividend, but that's not always necessarily the case. But I probably would stay away from it if they were accustomed to paying big dividends. What's your thoughts on PFPT? To be quite honest, I don't even know is that a stock, PFPT? I haven't traded it. So let's look at it. It looks bullish. They've got super low implied volatility. They bounced back from their earnings. Oh, the POC level. Wait, what? No. So you are looking at are you saying the PFPT is the POC, the point of control? Is that what he's saying? Not the stock? Would you look more than 1 year to see if there are support resistance levels, which I assume your market profile and the TPO profile will show other support resistance level? Wally, I usually, with my Fibonacci's, for instance, with my Fibonacci, if I saw this as the low here, and today I built this off of this low, and kind of just threw up those Fibonacci's, and next couple of weeks, I would probably leave that level in there. I'm not going to adjust it to this level necessarily, although that level actually looks probably better. As a matter of fact, I would probably at this point even go from that level. That's such a strong support level that I would think I would go like that with this Fibonacci level. Okay. All right, so what's another one was, so actually we're getting kind of close. So let me throw a couple out there that I vetted. Let's see if any of you guys picked it. NVIDIA was one of them that I saw. I think I got enough time. I can do a couple more. NVIDIA. So NVIDIA looks bullish. NVIDIA is just crushing it with the cryptocurrency. When is their earnings? Their earnings are still yet to come, so I'd stay away from it. It does fit the rules all around the other side of it and everything else. As you can see, NVIDIA 10 cents wide on a $200 stock, 15 cents wide. What's my rule? 3 ticks left, 25 cents wide would be that. So 10 cents wide is great. I love NVIDIA's options. Anyway, so next one. Now, you guys, this is one of those stocks. This is the stock that I said I couldn't wait on for you. All right, usually I go over all the ones that I vetted, and sometimes you guys throw out ones that I missed and will implement on Monday. So watch those daily market commentaries. I'm going to be talking about this on Monday. So Starbucks, I couldn't wait for you guys. If we look at the charts, Starbucks came down, you know, there you could say that this is a double bottom right here. That's a nice little candle, right? Yesterday's big rally kind of left me to be a little bit bullish going in the near term here. We've got confirmation to the upside, blasted through the 200-day, went through the 9-day, tried to, you know, now it's at the point of control for the most volume, but it could settle down there. I don't care because I'm selling puts, right? My market assumption is bullish because I've got a confirmation. My market assumption can be sideways. So if it gets settled down here, and that's a lot of trading with some of you guys that know with market profiles, it has a tendency to settle down around these levels. So in that, where would I want to sell it? Well, if I was going to sell a put, I'd like to sell it somewhere below this level. You know, you can throw up Fibonacci if my Fibonacci wants to work for me. You can throw that up and say, okay, well, there's a lot of support there. Got the volume POC there. I'm going to sell some puts in here. Well, that's what I was saying today. This looks like a good stock to do it in. And I sold these when they were around a 20 delta. So obviously the market came off a little bit since I had done these. I sold them for, I think, 50 or 51 cents. But it was right around this 16 delta because all of those things, you know, I went through it. All right. It's got high implied volatility percent. It's already had an earnings. I think all of the bad news is behind them. They've gotten this market move. I've got 2 Fibonacci levels. You know, I'm basically selling those puts below several different support levels. Those 55 puts are, you know, right here at the point of control, plus my collection of 50 cents, you know, 54.50. So even if it breaks through this, it breaks through the 200-day, it breaks through the 23, goes down to the point of control. I've got a lot of different support levels. I got a lot of different things going my way, and that's why I had to pull the trigger on this, you guys. So that's why I played this to the upside when I was going through trying to vet these. But Starbucks volatility is way below the 50 level. No, it's at 50 IV percent right here. Or I can even look at here, it's 52. And one thing I said I was going to mention how to figure this out. The way to figure out IV percent, did you sell in May or June? I sell premium every month. But the way to figure out IV percent, you guys, is numerator to denominator. In the numerator, we take the sum and divide it by the sum in the denominator. Well, the sum, or the what we put in the numerator, is where it's currently trading, 22. IV percent is 22, and subtract that by 14. So 22 minus 14 gives us, or actually it's a little bit lower than that. Let's just say it's 22 minus 12. That's 10, right? Divided by 10 divided by the high minus the low, which is 20 so 19. So 10 divided by 19, that's pretty close to 50%, right? So that's how you come up with that. All right, does that make sense? How would you manage this trade if the stock heads down towards your short put strike? All right, well, you may have missed it while you're picking up the kids, but what I was saying was, and I'll repeat it because some other people might have missed it too. If I sold these, or I did sell these, so I sold these, and the market comes down here, the probabilities of me being tested on this is about 40% during the next 42 days. But that being said, if it goes down here and it, you know, kind of goes below me, it's breaking the probabilities. I'm getting a little bit worried, but my market assumption is still bullish. You can go in and sell some calls. Don't buy puts. You're throwing good money at bad money. Sell some calls, collect more premium, increase your break even to the downside. You are increasing your risk to the upside, but usually when you're doing this, it's because it's getting close to the end of expiration and you're just a little bit worried about settling right there on you. The other thing would be is if it broke, for me, I'm getting that good price down here. To me, if it broke below this Fibonacci level, which is what made me set it up off this candle, that's where I would get out. But I have a higher risk tolerance. You might, or somebody else might say, well, when it breaks below if it goes back below the 200-day, I'm getting out. Somebody else might say, if it gets below this, stick with those rules that you've set up for yourself on a bad trade going out. To me, I would say the candle that I was looking at for support, if it breaks that, that's where I usually will look to get out. Does that make sense? How about going the short straddle from the start? If you wanted to do a straddle to begin this strategy, you could. The other thing is, this is defending this. This is staying mechanical. If it comes down here and tests me on this, which I have a high probability of success, almost 50% right now, that it's going to be tested. I'd probably, in a couple of days, if it went down there and hit me, I'd probably sell this strangle and be like a $5 wide strangle or something like that. But if my market assumption changes, I'm out. I'm not messing around. Sell the calls at right around a 36 delta is what I would be my perfect strike delta would be about a 36 delta on the calls. Okay. Yes, I sold these June 15 puts in this account, my IRA, and in my other account. Well, actually, I did it in my other account. I put it in this account. One way leg will be right. Well, that's what we're hoping for. Usually when you're putting a strangle around that, you're getting a little defensive towards the end there. And the reason why I like to start out with the strangle is because if it goes even further, then I can roll even down further for a better credit and create the straddle. Now, I have gone inverted, but if you do go inverted, just keep in mind you are locking in a loss if the market were to bounce back up. Right? And that would be if your market assumption is still up. Cash secured puts require a lot of margin. So instead, what about doing the BPS, perhaps the 10 or the 30 point wide? Yes, Chuck, you could definitely do that. Where, like in my IRA, for instance, to sell puts is margin intensive. So what I do is go and buy the first option I can for a nickel. Now, to me, that would be these 45s because I think I would be able to buy those for about a nickel. I wouldn't want to necessarily pay all the way up for a nickel on that one. So I'd probably try and work this one for a nickel, but sell that and buy this one, which is what I did in my IRA when the delta was a little bit more favorable. I think it was around a 21 delta. These were a nickel. So I sold these for 50 cents, bought those for a nickel. 45 cents is the collection. That makes sense? And yes, and you could roll. You could ratio, you're saying ratio, sell more calls to the puts. I'd probably go 1-to-1 myself. But the other thing to stay mechanical is to roll it out in time. And that's something I forgot to mention is the other way to do it is if we're at like 14 days to expiration and my puts are in the money, that's where I'm going to roll those out in time. Because I don't like to take this in the last 7 days. Too many things can happen. All right. That's about it. If you guys don't have any more questions, it's pretty simple. Just look for the 16 delta. Obviously, I had to pick them between the 16 delta and a little bit lower. I went a little bit higher because I was more bullish. So start at the 16 and then kind of decide what kind of risk do you want. Generally, I'll move further out, but this one was just, I thought it was too good to be true. So I went a little bit closer. Would you roll in time at the same strike or a different strike? I would go for the same strike. I'd roll it out straight for the same strike and collect more premium. Is there a minimum premium that you're looking for? Absolutely. I would not collect less than 30 cents for this strategy. I'm just going to walk away from it because basically after you pay commissions and everything else, it's a lot of risk for making TD Ameritrade more money than I made, and I took the risk. They took a little bit of risk on me because they're giving me they're letting me lever up on puts, but at the end of the day, I look at it as me. How did you calculate the IV percent? This IV percent 52, basically you have a numerator and a denominator. So just draw a line on a piece of paper, and the numerator, which is on top, you take where the current IV is, subtract that by the low IV. You take that sum and divide it by the high minus the low that's in the denominator. Okay. I'll do one more for you, Gary. I'll do one more because I think I missed Gary's stocks. All right. Triple D just had earnings. They lost money, 3 cents. It's not bad. Volatility looks like it's coming out pretty dramatically. So IV percent is only 24. That's really low to be selling. 30 cents minimum. Yeah, I'm going to try and leave it at 30 cents. Otherwise, I'm going to move up a strike. Yeah, 30 cents. Because, yeah, if you take 30, that's why I'm saying I'm going to not take less than 30 cents. You take 30 cents, 50% profit, that's 15 cents. After all the commissions, they made more money than me. The IV is based on 1 year. And I have friends that have to do this calculation all the time because they only go 6 months back. And I have no problem if you'd like to do that as well. I have no argument. Yeah, triple D is just a little, these $9 stocks, it's hard to get any premium. I'd almost rather buy the stock at that point, right? Or do a poor man's covered call or a synthetic long, something like that. All right, hey guys, in the chat window, I've got the link for how to trade options like the Wolfman. Goes through a lot of great stuff, how to trade just using gamma. So if you want to take this stuff into the last 7 days, or you like trading inside that last 10 to 7 days, this is a great one. Basically what I do in all of my webinars, you guys, all of these things, how to generate option or how to generate income with options, protecting your portfolio. The most underserved part of your portfolio, you guys, is the bond portfolio. Everybody forgets about it. And you guys are going to be getting decimated not watching it because interest rates are on the rise, and that is going to cause those prices to go down. So if you have $100,000 in bonds, if interest rates start going up, you could see that value halve. You will still get the premium collection from, or you'll still get the, coupon collection. You will still be able to get out at par if you hold it for 30 days, but most people hold them for 7 days. And you can't chase a higher coupon because the price, traders know that if you're chasing a higher coupon, they're gonna buy this bond back from you below where you can make up the amount on a coupon. All right. How do you get the daily market commentaries, Chuck? You basically reach out to us, trading at protraderstrategies.com. That's part of our premium membership. Leap diagonal. I've covered just about everything. I've done diagonals and all that stuff. Yeah, absolutely. I don't usually do leaps a lot of times, Chuck, but I will go out, a few hundred days. But I usually don't go out longer than 1 year. I did do those 2-year puts in Tesla, but at the end of the day, you guys I think everybody probably took something away, even if you're a savvy trader, right? I mean, whether it's the 2 times the delta, you can always take something away from my webinars, but I always try to teach based on probabilities of success. I mean, don't you think that if you're trading with probabilities of success, that helps separate some of that emotion? It's because you're calculating math. It's all math, you guys. And if you think about it in those terms, you will be able to take some of that emotion away. And You guys should all be trading with all of this knowledge. This is super important. The best way to become a better trader is to constantly learn, which you guys have obviously done by attending this webinar and probably other webinars. But when you say that just knowing how to create an option strategy, anybody can go out there and tell you how to sell a put, right? You go out and sell a put. But they aren't going to give you strike locations and tell you what those probabilities of success are, and then even further go into how to stay mechanical. They're just going to say, hey, go do this based on an assumption, and they're just basically, shooting from the hip for the most part. Basically what I mean is, if you're trading even just using technical analysis or building strategies, the best way to get ahead in this game is to trade with probabilities and become more mechanical, which is what I try to teach and constantly champion. But not even building a strategy is going to increase your probabilities of success, but no one else is going to show you how to do this with strategies on your probabilities. And I teach that, how to trade those probabilities when the probabilities have gone against us, how to be mechanical, like I talked about selling those calls, right? And what not to do by buying those puts. I'm going to tell you those things so that you can increase your probabilities even further, all right? So go ahead and click on that in the chat window. Like I said, we've been communicating back and forth on the questions box over there in the chat window in the main bar. You'll see a little thing there that's an easy link to this. If you're watching this on delay, just pause it and punch this into your URL. Option courses / how to trade like the Wolfman. To get all these for $36 is a major discount. You can call us at 310-598-6677 if you have any questions or you want to know more about those daily market commentaries, or you can email us at trading@protraderstrategies.com. With that premium membership, you also get access to me, you guys. So like if you have a question and want to talk to me about a particular underlying strategy, something that's gone against you, I will talk you through those. I won't give you what I think you should do. I will just tell you what my rules are and what I say is how to calculate what your probabilities are, all right? So I'll tell you, hey, if it were me, this is what I would do. You would have to take that and do with it with what you wish. Does that make sense? Are your options courses suitable for trading futures options? Absolutely, Andreas. All of these rules follow through with everything. Absolutely. Is this being recorded, Bill? Yes, it is. And we will be sending it out pretty shortly. Great webinar. You are very knowledgeable. Thank you. Thank you, Noel. I appreciate that. But guys, take advantage of this and or the premium membership for the daily market commentaries, access to me, and a lot of other things as well. But this is the one we're giving you. History of options. You can blow people away when you start talking about the history of options. You can draw job people on it. It's pretty funny because most options traders don't even know that stuff. Gary signed up. All right. Thank you, Gary. Appreciate that. Finally, I just want to thank you guys all. Later webinars, I'm going to be drilling down on different option components, when and where I find trades and when I find them appropriate. Also, here's that link again, how to trade options like the Wolfman. It is a dead link. Sorry, you guys are going to have to pause it if you're watching this on tape delay. If not, it's over, like I said, over there in the chat window. Thank you for watching. If you have any questions, you can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. All right, that's about it, you guys, unless somebody has another real quick question for me. I don't see any coming up, but that's about it. If you can't take that, take it easy. JQ got it again. All right, guys, take care. I see a couple